Well, welcome your backup plan tribe to this week's podcast is on life insurance and disability. Imagine that, such a wonderful, fun topic as that. But hopefully we can all provide you some little tips and tricks to finding out what you have, what you need to get, and all that fun stuff with our new guest interview this week. For those that are new here, my name is Tina Ginn. I am an emergency preparedness coach, a best-selling author, a financial expert, and an app developer of your Backup Plan app. And I'm located here in Vancouver, British Columbia, and you can expect product reviews, tips and tricks from our guest interviews, workshops and tutorials, and my channel provides real life people with real life stories. So if you're new here, go ahead and click on the subscribe button down below and tap on the bell to get notified and don't miss out on any interviews or videos. So today, welcome. Jared Merkel is here with us today from Merck Financial Group in Vancouver, BC. He is a CFP, and I'm so excited to bring him on board to our podcast this week to talk more about life insurance. Imagine that. Because I know when I first got into selling life insurance, and people used to say, do an elevator speech, do like a little elevator so that you know what to say to people. And I would be so nervous, and I sell life insurance, and everybody would turn around real quick and walk the other way. So hopefully our listeners aren't walking and turning around the other way. So welcome, Jared, to our podcast this week.
Thanks, Tina. Thanks for inviting me. I'm happy to be here.
Well, our topics could probably go on and on and on for all day long, but we're going to make this short and sweet and talk about what types of life insurance are there, Jared, around?
In the life insurance, specifically in the life insurance marketplace, you really are looking at two broad topics of temporary or term insurance and permanent insurance. Each of those categories will break down into subsets of products. Term will have different periods of time over which the term will be eligible for. And permanent insurance will break down into two broad categories, again, being universal life insurance and par or participating or non-participating whole life insurance.
And the difference between the permanent of the universal and the whole life, Sun Life used to have a great policy. I think it was widely used, and then they went public, and then they offered anybody who had their life insurance policies a buyout. Mm-hmm. So today we can do all sorts of things by keeping our life insurance forever versus having a term which will end.
Without question, the definition of par or participating is that when the companies initially offered it, they were all mutual companies. They were not publicly traded. They did not have shareholders. And by virtue of buying the policy, you were taking ownership in that asset pool, which was often one of the largest asset pools that the companies would have. So when Manulife demutualized in 1998 or 99, I think, every Manulife par policy holder, they got a payout too, because their par policies were the equivalent of shares in a mutual company. And most of the insurance companies now have gone public. There are a couple of anomalies that are still privately owned, some of which still have participating policies. But the par concept is still very broad. It is more difficult from a product perspective for a carrier who is publicly traded to offer a par product, because those par or participating owners get priority over shareholders, and shareholders don't generally like anybody having priority over them.
No, and so they should.
Yeah.
So when you're doing a financial plan, it's good to, wherever these listeners are listening from, because I'm sure most of the Commonwealth countries are basically all the same, primarily, with a few alterations to their policy types and the companies they offer. But definitely look, for people listening, look at whether you want it for 10 years, do you want it for 20 years, do you want it for 30 years? Or do you want it to end at a certain time? Maybe it's a rental property you want to insure. Or do you want a permanent policy that you're not going to lose and that you could benefit from either, no dividends in the policy or with dividends in the policy, so to speak?
Yeah, I think when financial plans are drawn up, solutions that are needed by clients are lined up with the products that are most appropriate. And so, in my experience, it's very rare that there's going to be a client who is going to wind up in a place where they need zero life insurance. There is this concept out there being self-insured. But at one time in my career, my role was focused on supporting and training other advisors. And I worked with another advisor team who was putting together a $160 million insurance policy that took 4 insurers to put together. And the life that they were insuring, the individual they were insuring, is a billionaire. And so if that billionaire who needs $100+ million of life insurance isn't self-insured yet, I would argue that us normal mortals are not likely to reach that point either. So the best insurance to buy should be bought yesterday, and it should all be permanent, because the need isn't going to go away. It may change. And if you have permanent insurance, you're now in control of that contract, and you can make those changes. You can decrease your coverage if you need to, if you see the need to. But if you don't have it, getting more of it is often very complicated. One of the great things about the Canadian life insurance market, which is true in many Commonwealth or developed markets, but certainly in Canada, the products are unilateral contracts, which means that once you have been issued the policy by the insurance carrier, as long as you pay the premiums required, they can't ever change the policy on you, not the terms, not the conditions. And so you maintain a great degree of control. The challenge then becomes the price gap that exists between temporary insurance and permanent insurance, because temporary insurance is a lot cheaper, which often becomes a sticking point for clients when they're trying to figure out how to put their coverage together.
When I sell life insurance or when I offer it to my clients, I like the combination. I like a little bit of permanent and a whole lot of term.
And that would be 100% of the time, that would be my recommendation for clients. 100% of their need is not going to be permanent, nor can many people afford 100% of the need in permanent coverage. So that blend becomes very important. And now what you do is what I said earlier, you match the need with the product. So you take the needs that are going to disappear over time and you give them the temporary coverage. You take the needs that are going to last there for a lifetime and you match them with the permanent coverage. And now you're able to create a more affordable product.
Right. So that brings us right into those clients that say, hey, Jared, I don't need any life insurance. I have some at work.
Yeah, in the life insurance world, we go through there's a very small list of objections that advisors will face when clients look at the concept of life insurance, and probably the most common is the I'm covered through work, and the answer is yes, you probably are. If you have a job with an employer who has a good employee or benefits program, then you've got coverage, and it's a multiple of your income. It's 1 times your salary or 2 times your salary. The challenges become how that's going to work for you over your lifetime. So the first thing I would argue is that, if I asked what retirement meant to people, we would probably all agree that 40 years ago, it meant starting a job, retiring at 65, getting a gold watch and walking off in the sunset. And now, our children are going to have jobs in businesses and fields that don't even exist yet. That's how fast the world is moving. So we aren't going to stay where we are. We aren't going to have a 40-year career with our company. So we have to worry about 2 things. Number 1, if we change companies, what will the next benefit plan look like? And number 2, if our company needs to save money, will they shave our benefit plan? And if so, will that affect what of our benefits? And if we lose our life insurance benefit, we are now older than we were yesterday when we considered this problem. We are therefore more expensive to buy our own coverage. So it seems to me to be an inevitable need for every Canadian to pick up their own policy and then have themselves protected at an amount they can be confident about, to be paid out under conditions they can be certain about in their own contract. Mm-hmm. And again, as long as they pay the premiums, no one's ever going to be able to take that plan away from them.
I had one big case where I met with a woman who was 59 and she had life insurance with her work benefit program at work,
Mhm.
and she got cancer. And she wanted to then leave the company and retire early because she felt that she needed the time to recover. But she wanted to take her life insurance with her. And for me to reevaluate her life insurance and give it to her through the work benefit program, it meant that she was very high risk. Even if she was going to take it with her, it was going to be $700 a month for $100,000 of life insurance.
Mhm.
And that was with her taking what she had. So, of course, she decided not to. I've had multiple people think that they had coverage and it was either at work or it was going to end, and created issues anyway. So I always say to people, well, if you want to do an investment, are you going to give the investment to your company that you work for to look after? Or are you going to go get your own and look after it yourself? Because you
Yeah.
can't count on what the employer is going to do, especially now.
No, even if you're going to assume you're going to be with them until the end of your working days, and that still leaves an argument about what happens about your life insurance needs after your working days. But if we assume you're going to be all the way till 65 or whatever that number is, great. But that doesn't give you any confidence about what the employer is going to do with the plan. And having worked with employee benefit packages before, I can tell you that they make changes all the time. Every year that product comes up for renewal with your employer, and your employer goes over the benefits that they offer and the costs that that brings, and they make changes. They switch carriers, they switch products, and we're not even touching on the massive movement into self-employment that's been going on for the last 10 years in the marketplace. Those people leave businesses and jobs where they had plans and have nothing, and they're completely on their own.
Well, and COVID this year has really opened up a whole can of worms when it comes to laying people off and what happens to their benefits.
Yeah,
So,
it has. And I when I talk about what we do as financial advisors, and the solutions we provide, and the work that we do, I've always joked that nobody's ever woken up one morning and said, I want to sell insurance for the rest of my life. That's not how you got here. That's not how I got here. Yet we're here because we realize what it can do. And the other joke that I have is that when things are good, people want to protect their stuff, so they need insurance. And when things are bad, people want to protect their stuff, and so they need insurance. So this business, this service that we offer, this advice that we give, it's recession proof. And when things are in question, as they have been with the COVID times, it's given a lot of people the impetus to reevaluate what their plan is. It's also given, as you said, a lot of people a lot more time than they're used to having, because their jobs are shut down or gone.
yeah.
And they've had to figure out how to protect themselves, because all of a sudden that employer that was doing it for them isn't doing it anymore. And in many cases, the employer isn't even there. In the last couple of weeks alone, we've seen some very big brand name retail companies go out of business, and it's not over yet.
No, unfortunately, it looks like it's somehow getting worse. I'm not really sure what angle that the world is going to take, but it's quite scary.
It is, and that's why I have two young daughters, and between the three of us, we have 13 insurance policies. Because every time cash flow allowed, I would add more insurance to what we were covered by. And if I get to a point where I decide that I can't or don't want any of that, I can cancel it. I'm in control. However, the reality is I'm probably looking for policy 14 and 15 in the next couple of years to keep adding to that portfolio. The truth of the matter is, Canadians specifically, North Americans, spend more time annually planning their vacations than they do planning their finances. And it doesn't require a lot of work. That's what you're here to do for them. They just have to engage you, give you the information, let you do your job, and present to them, a highlighted, outlined plan of here's what you've got and here's where it's likely to get you. And if that's not acceptable, let's look at how to fill the gaps.
Well, and I would see lots of letters come in and they show me this piece of paper and say, Tina, I just got this in the mail and my life insurance is going up.
Hmm.
But it wasn't my policy. And why is it going up? They never said it was going to go up. Why is it going up now? And I'd be like, well, let me take a look at it and I can tell you why pretty quickly.
Yep. Um, One of the first advisors I ever worked with in this business, going back a number of years now, said to me something very amusing that I've never forgotten. He said, every client you ever work with will be stricken with the same disease, and that's amnesia. Because what we do and why we do it and how we do it is very important to us. But for clients, it's the end result that's important to them. And so they come back to us over the course of our relationship, which for many of us in this business, it's a 20 or 30-year relationship with these clients. And they come back to us to remember why they chose what they chose and how it works and what are the details. And you're right. I have rarely met a client who has bought in term insurance, or as I call temporary insurance, and have come up to the renewal date, if it's a 10-year term in the 10th year or a 20-year term in the 20th year, and gone, oh, I remember this.
Yeah.
I remember that I was told that it was going to go up 6 to 8 times in premium. And I remember that we bought it because it was inexpensive when we started. And I'm okay, let's continue on. I mean, that never happens. It never happens. And so we get into these awkward conversations where we have to try and help them understand what the choices are going forward. And like I said, the best insurance is the insurance bought yesterday, because you know what your health was yesterday and you know you were younger yesterday. Waiting and waiting and waiting and postponing this decision, Canadians don't understand how expensive that is. It's a very, very expensive proposition to postpone making the financial plan and laying it out.
Yes. And I always said to people, if you don't want to go the permanent route because you might find it a little bit costly, then do multiple temporary, some multiple, um, what do you call it?
Layered coverage.
Yeah, just like some 10, some like, and maybe
Exactly.
build it up lots when you need it more and then less and less and less. But have some plan over the whole period of time, not just look at these 5 or 10 years. And that's
Absolutely. And one of the nice things about term, and there aren't many of them, but one of the nice things about term is that it offers the ability to convert into permanent coverage without proving you're healthy later on. That's wonderful, except that you're going to pay the rate at the age you choose to do the conversion. So if you buy it at 30 because it's the inexpensive option, and at 50 you decide you better lock it in before the rate goes up on your 20-year term, you're going to be in for a real surprise about the cost of making that change at that point in time versus what it would have cost you when you took out the product in the first place. So we go back to, I think you have already illustrated really the best solution, and it's to create that layered coverage with a little bit of permanent and term riders to back up the rest. And even there, you can layer the term coverages.
Yeah.
Permanent with term 10, with term 20, with term 30.
right. That was my ideal situation.
Yeah. Yeah.
Unless if somebody had a rental property and they wanted to insure the partners, and then that way, I would say, well, how long do you think you're going to keep this rental property for? And they say, well, 5 or 6 years. Well, then do a 10 or 20-year term policy, because that makes sense. But somehow people can envision what they're doing for rental properties or that sort of thing, but not for themselves for later on. They can't seem to envision themselves past 65 and 85 and what they're going to need then.
Yeah. I've sold very, very little 10-year term insurance in my life. I call it a 9.9-year problem because it's too short. Our lives haven't changed sufficiently enough that the insurance need has gone away to the degree that we expected it to. It's naive of us, I think, to think that way, but we do. But one of the 10-year terms I sold was to a business owner we were doing some business planning with he and his partners, but he was over 60. And he was admittedly going to hang around for probably up to 4 more years. And then he was exiting the business and selling it to his younger partners. There was no reason to spend the money to take any of the longer terms to lock in any of the rates. He simply wasn't going to be there. And once he wasn't there, all of his personal needs were covered under personal policies. It was a corporate policy. So again, we're back to this concept of picking the right insurance to match with the need. The length and term of the insurance should match the length and term of the need, i.e., if we're inevitably going to pass, we're going to need a box. We're probably going to want a party. There's a few things that are absolutely unavoidable. Well, we need permanent insurance for that, or we risk not having it. So we start there and we build from that.
And I always say with blended families, which there are huge amounts of them now, that the permanent insurance really, really helps out the blended family situation as well. So people should consider that, because they're going to want to give something to their own children, and that other partner gives something to their own children, so that you
Yeah,
keep your.
absolutely. And you touch on something else there too, that is one of the wonderful natures of insurance. The beneficiary designation that they make in those policies is a very private thing. Only the people who are aware of what the beneficiaries are, which is typically the life insured and the agent, know about the insurance. And if the life insured has no interest or willingness to disclose that information, they don't have to. So they can choose to take care of their family in any way, shape, and form that they choose to. When they pass, the carrier will provide the checks. The beneficiaries will receive the checks, and nobody has to tell anybody, as opposed to this process of, passing away and having a public estate and having that probated, where now everybody knows what everybody's getting, and there's arguments over, the china and the silverware.
Yeah,
So there's some really big advantages to life insurance that go well beyond the concept of the actual insurance. It goes into how it works and how it pays out.
exactly. And then to top it all off, not only do you get a life insurance policy, but we talked about this in funeral arrangement planning as well. But if nobody knows that you have that insurance policy, guys, it's not going to be any help to anybody. So, except
Yeah,
for the
and
insurance company itself.
you bet. And so I would make a couple of advertisements here. I would say, number one, the worst place in the world to put an insurance policy once you bought it is in your safety deposit box in your bank, because once you're gone, pretty much nobody can get in there. No, and that's a problem. So number two, you have to be on top of who your beneficiaries are. You need to know who your beneficiaries are. You need to be on top of that, because that's the kind of thing that changes. When your kids are under 18, they can't be a beneficiary. When they're over 18, at some point, you'll probably want them to be a beneficiary.
Right.
And then we start teaching our clients this concept of contingent beneficiaries and contingent owners, so that in the event that the beneficiary you chose is no longer there, and that's most commonly spouses, well, then you have another beneficiary already elected in the policy. There doesn't have to be any debate or conversation. Most importantly, the insurance proceeds don't have to pay into an estate and then be subject to delays, battles, taxes, lawyers, fees, etc.
Probate.
It still becomes an insurance payout to this second beneficiary, because the first beneficiary isn't there. This can all be accomplished with good financial planning. We just need to spend a little time writing it and keeping it up to date.
Right. And understanding
Yep.
what you got and why you got it. And that's why your backup plan is absolutely here, because we are going to have your backup plan blueprint set up for this following month. And life insurance and disability will be a section of it, so you can understand how you should keep your policy after you get it, how to understand your policy, how to look at your own plan and length of period of time, so that you can do your own shopping, find your broker that you wish to pick, and at least talk in the same language as they are, so that you have a better understanding and you're more open to looking at the whole picture instead of just the 5-year mortgage insurance. So we haven't touched on mortgage insurance, and I know we love it so much. So everybody seems to love mortgage insurance, but I remember about 20 years ago, it used to be cheap, and it's
Yep.
not anymore.
Yep. Well, I would, without trying to offend too many institutions, I would suggest that, first of all, mortgage insurance doesn't exist. It's a name, it's nomenclature that's attached to life insurance. It's just life insurance, no matter what they call it, and no matter who sells it to you. The question is it good life insurance or not? Because now we get into, what does the contract say? What protections are you offered? And there's some really great media sources to go and figure out the differences between the types of products that are out there, especially in the marketplace designed to be quote unquote mortgage insurance. I would probably, you're aware of that CBC Marketplace YouTube video you may want to link. It's great information about the realities of mortgage insurance.
And I believe W5 had one as well, which I could link as well.
Yeah, I think it's the same one. I think we're talking about the same one. It's a 2-part episode, and it's been on YouTube for quite some time, and it talks about the realities of your own policy versus a bank-owned policy. Yeah. Yeah, the mortgage insurance has changed a lot over the years. It is a product that does a fabulous job of providing profit to lending institutions and protecting lending institutions. And so if when you buy your house, you are very concerned about protecting the lending institution, then mortgage insurance is probably an excellent vehicle for you. If, however, your concern is protecting yourself and your family, you might want to look a little deeper. You might want to look a little harder, and you might want to seek advice from somebody outside the lending source who's incented to provide a product from within the lending source.
Absolutely. Um, well, I always say to people, it's better than not having anything at all. So
I would agree with that. And, when I talk about the different types of insurance, and we talk about three very broad categories when we do personal insurance, it's life insurance, disability insurance, and critical illness insurance. I put life insurance at the bottom of the priority list. And the only reason I put it at the bottom of the priority list is twofold. Number one, most of us, when we pass, we own some stuff, and
Yeah.
people get our stuff, and they are not left worse off than when we were here. Number two, we have it in a variety of forms in the course of our daily lives. We've all had calls from our credit card company trying to offer us life insurance on our $5,000 credit card balance. We've had mortgage insurance offered to us. We've had all kinds of employment benefit packages that give it to us. So it is the lowest priority of the three in terms of where I need to go, or I suggest advisors go to look, because it's the most common and most often talked about. We need to start at the things that are least often talked about, most often neglected.
Well, and you're living the life, you're not passed away. So of course I guess in the insurance business, we call it a me product. That is disability and critical illness. And of course, critical illness policies, for anybody that's out there, there are many different types. There's anywhere from, I believe, the smallest amount is 6 critical illnesses all the way up to like 30 different critical illnesses for policies for different companies that you can purchase. But I love that product because not only can you get it for just in case, but you can also get all your money back after a period of time with the return of your premiums that it's like another investment that you put away just in case. And then when you don't get a critical illness after a certain length of time, you get all your money back. I mean, it's a no-brainer.
It's a phenomenal product. It is the top of my priority list when I talk to clients. It is, as you said, under the category of selfish insurance. It doesn't matter if you're young or old. It doesn't matter if you're married or single. It doesn't matter if you're divorced or widowed. It doesn't matter who you are in your life and lifestyle, because it's not designed to be here after you're gone. It's designed to be here when you're here. And I often describe it this way. Money is a mechanism of choice. If you and I head off to the mall and somebody hands me $100 and somebody hands you $1,000 and says, have fun, we will both have fun. You will have more fun than me, approximately 10 times more fun than I will. That's all it is. It's just a medium of choice. You will have more choices because you have more money. So if you translate that into receiving that news about that, dire life-threatening condition that's been, handed down to you from a doctor, you now have some pretty hard choices to make. And we aren't talking about your ability to work. We aren't talking about whether or not you're going to die. We're just talking about the realities you're going to face, and whether or not you want a lot of choices with that. Do you want to choose, I'll back up for a second. I will never beat up on the Canadian medical system. I think we want to have one of the most admirable health and welfare systems in the modern world. However, everything has its limitations. And in order to be treated in Canada, you will go where they suggest you go, when they suggest you go, unless you'd like to make a choice.
With who?
With who they like you to see, yeah.
Yeah.
Unless you'd like to make a choice. And if you'd like to make a choice, well, now you're going to step outside the system, and how are you going to afford that? And without even getting into a conversation about alternative medicines that wouldn't be covered and all of that, which is absolutely true, we can stay in the traditional medicine realm and say, if you're injured and you need an MRI, but your life isn't threatened, you'll wait over 6 months for the MRI. I can say that with great confidence because I've waited over 6 months for an MRI. I've also been in another situation where I needed an MRI, and I wrote a check and had my MRI the next week. that is only money and choice. And it's a very small example of something that was in neither case life-threatening, but it was an examination that needed to be done. And in one case, I had the money to make the choice. In the other case, I didn't. And so this critical illness coverage provides a lump sum benefit if you're diagnosed with any one of the covered conditions. And I think actually, Tina, you will find coverages down to one condition. And I think the biggest ones are, yeah, you're right, they're going to be over 30.
Yeah.
So it depends on how robust a plan you want, which allows you amazing construction options in terms of affordability and coverage that you're looking for.
The only hard part I find in a client deciding whether they want critical illness isn't so much do they want it, but they of course want the one with 30 options of critical illnesses, but want to pay for the one that has one. So,
and they want to pay the 10-year term rate, but get the permanent coverage and the permanent protection.
But you know, it's all there for choices, and it enables you, whatever you pick. I always say to people, whatever you pick, it's going to give you options later on, which you
and there, and there too, to your point earlier, you can layer the coverage there as well. You can take permanent, you can take temporary. There are return of premium options to get you all your money back, either when you die or at a date in the future when you choose to collapse the plan. There's a ton of flexibility around the product, and the definitions in terms of what is covered are handed to you in your contract. So there are very specific definitions for each of the conditions, and as long as your diagnosis meets those, you're going to get a check. And I'll share, just because I know a few of the statistics, but north of 90% of claims in the critical illness marketplace are in 4 conditions: cancer, heart attack, stroke, and coronary angioplasty or coronary bypass. That's 90+% of claims. And I would suggest that somewhere around 70 to 75% of total claims is just cancer. And so oftentimes when advisors talk to clients about this product line, they introduce it as simply cancer insurance, because by and large, that's what it's covering. And that's what we're all seeing in our lives. You can't find someone whose life has not been touched by cancer, either their lives or their parents, families, extended families, or friends.
Absolutely. I think it's a great investment in yourself, especially if you have a job that you're self-employed at, because that's really going to hit harder than if you're an employee, of course.
Well, you bet. And the mathematical truth is, if you put yourself in that situation, you say you are diagnosed and you say you need to make choices, and whether it's choices in care or choices in taking time away from work, you take a leave of absence because you want to focus on your health. The number one contributor to ill health is stress. The number one contributor to stress is money. Critical illness is literally a way to aid in your own care if you are diagnosed, right? So it is selfish insurance, but it provides in ways that the math is not so easy to see. If you needed $100,000 today to make whatever choices you wanted to make, you would have to take $177,000 out of your RSP, because you're going to get taxed on every dollar that comes out, and it's all going to be income. It's going to be very, very expensive. And I think you and I both know what the average Canadian RSP is, which means that there aren't a lot of people that even have the $177,000. And then we have to start talking about how long does it take to put all that money back in, because you haven't died. This isn't death. You are still going to retire. You are likely to survive and live a fairly long, healthy life. And certainly your family is. So now you have to replace all the money that you've gone and spent at a time when your health has been hit. It makes so much sense for so many reasons.
And for any listeners out there, an RSP in Canada is a retirement fund of some sort of investment that you've put away for yourself. But of course, it's hard to take it out because you usually have to pay some sort of taxes. And then when you go to put it back, that's even harder.
Yep.
So how do you know if your disability policy will do the trick when you need it the most?
The simple and somewhat cheeky answer is you give it to a qualified advisor and have them redline it. Your advisor who you are working with better have asked you to provide them a copy of your benefit plan at work so that they can redline it, because that's fundamental planning 101. If we're going to try and consider what you've got as group coverage as part of the coverage plan, we need to know what it says. And a good advisor can do that in literally minutes because they know exactly where to look. By and large, there are two pieces of a disability coverage that an advisor wants to examine quickly. The first is how is the benefit calculated? Often there's a formula relative to your income, and it tells you how much you're going to receive and whether or not there are caps on what you can receive. And you have to be very, very careful. In many cases, bonuses are not included. So your benefit for disability will be based on solely your base income. And in some careers, in some people's lives, their base income isn't the lion's share of their income. So they don't understand what they're protected for. And then you get to the point, sorry.
I had a client who basically made $2,000 a month base salary and the rest was commission. So that's their disability policies based on their base salary of $2,000 a month, basically. For
You bet.
Yeah.
And if you've got an $8,000 a month life and lifestyle with your family, with it based on a $2,000 base and a $6,000 bonus, and somebody says, don't worry if you're disabled, we'll cover your salary, and you think, great, I've got 8, and then you get a check for 2. I worked with a trucking company once, and these were a good group of seasoned truckers who, by and large, they make a good income. And when I went through their employee benefits plan, which had been provided to them by another advisor, the benefit cap stopped at about 35% of most of the truckers' gross income, meaning the other 65% was never going to get paid because the maximum payout would eliminate it. And so that's the kinds of things that advisors will jump into. And the other piece that they will look into that clients are certainly welcome to, they just didn't know they needed to look, is what is the definition of disability? And so like any contract in the insurance world, the wording is everything. And so in your disability, long-term, specifically long-term disability clause, it will say you are considered disabled if. And a very standard clause in an employee benefits plan will say that you are disabled if for the first 2 years, you cannot perform the substantial duties of your job. That's a pretty good definition.
Mm-hmm.
We call that a regular occupation definition. The problem becomes where most, not all, but most or many plans will have a different definition after the 24th month. And that definition will say something along the lines of you are considered disabled if you are unable to work, or you are unable to perform any occupation. And there aren't a lot of people out there who do a thing for a living who are prepared to have a doctor tell them that, well, you can't do your job, but there are a lot of jobs you could do. And the disability company says, well, then you're not disabled. And so now you're forced into a career or line of work just to make ends meet because you're getting kicked off a disability, and it had nothing to do with what you did. And that's tough.
Yeah, I always say to people, it's sort of like you have, what was I going to say now? You have a time frame that is 2 years, and beyond that, you might as well be lying in bed.
Yeah.
Because if you're not lying in bed, you're not disabled.
Yeah, and my joke would be very similar. I would say, imagine the control over your body you have to be a telemarketer. Because to be a telemarketer, all you have to do is wear a headset and talk on a phone. You now can do all of the rest of it by voice. You can dial by voice. So you could literally have missing limbs and be a telemarketer, which means you can still work, which means you may not be disabled. And I know that's an extreme example, but I give it to highlight the fact that there's a lot of range in there. And the choice is simple with any insurance product, but here specifically, if you want to take the risk, then don't pay the premium.
Right.
If you don't want to take the risk, if you don't want to put your family at risk, then pay the premium. And disability plans have a huge amount of customization available to them. They're one of the most a la carte plans that we offer to clients in terms of adding in different little pieces that can enhance and change the way the product will work. So we can manage that cost quite extensively to the degree that we can actually build plans that don't start until year 3, the end of the second year. So we will assume if you insist that your group plan will cover you for 2 years, fine. We'll start a program that picks up after that. We can do that too.
A lot of people don't realize I call it tiering it or double dipping or whatever terminology you want to do, but people think they have a work policy that's good enough. But once they start investigating and doing the research of what it looks like, they realize that, hey, it's not enough. Now what do I do? But a lot of times people don't even look at it. So what I want listeners to do is understand what they have at work and go to someone that can give them some other disability policies that they can top up. So you could get that gap in between what you're insured for and your top um, employment salary or commissions, or it could, if it ended at 2 years or whatever, then you could extend it further, or whatever that topping up looks like. But a lot of times people don't realize they can even do that.
They don't realize they can do that. They don't realize that they need to do that. And the other thing I will say here too is that long-term disability in a employment benefit package is usually one of the most expensive pieces of insurance. And so if we go back to our discussion earlier about employers annually reviewing benefits plans, I have been in conversations with employers where we have taken out long-term disability and we've offered something optionally to the employees instead, and it's completely changed it. And suddenly overnight, they're forced to make those decisions. So again, you can choose to get your own plan and know that you're protected, or you can wait and be under somebody else's plan, which means you're under their direction.
Whether they've discounted it or not, or whatever they've chosen to do, or canceled it altogether and you're not even aware.
Yep.
So yes, absolutely. So how do you know if you have a good policy?
I think the answer to that's the same as my answer to your earlier question. I would say that your advisor is going to tell you. Your independent advisor is going to take your plan, whether it's your group plan or the plan you bought from somebody else at some other point in your life, and they're going to review it and they're going to redline it or highlight it, and they're going to tell you what it is. They're going to tell you what you're covered for. They're going to tell you when it pays. They're going to tell you how much it pays. And then you're going to compare that to your financial life and make sure that that makes sense. The reality is no good financial advisor who's given good advice should ever be afraid of their clients taking the plan to another advisor. We shouldn't be afraid of that, because if we've done the right thing for the client, then it's the right thing for the client. Mathematically, nobody can argue that.
Right.
The only advisors who are afraid of having their advice pressure tested are ones who don't have advice that can stand up to the pressure test.
Right. And I always say too, please, if your advisor isn't checking your beneficiaries, to make sure that you are, adjusting that when the time is needed. Divorces, when you add children to the family, or, all of these kinds of things that might alter that beneficiary or the trustee that you name on your beneficiary, on your insurance policy. So please look at that. And I find that the majority of people do make the mistake on their business, on their employment life insurance, because they didn't realize, oh, what did I put for that beneficiary? And they did it so long ago that they don't remember, or they don't know if they did it or not. So, and again, your family does have a hard time knowing what they have at work if you don't have a section in your own at-home files knowing what you have at work, whether it's online in a digital book or whether it's in paper form, whichever it is. Please, as listeners, please investigate that further and find out what you do have so that you can make proper choices.
Yep, without question. And if you haven't heard from your advisor since the day that you were sold your policy, probably a good time to go get their advice tested by a different advisor. These are some of the most important or highest impact events that will ever occur in our families' lives. And we try and one and done them and don't go back and revisit it for 20 years when we buy our 20-year term. It's just not how it's supposed to work. We should be looking back over this plan, re-examining face amounts and beneficiaries and payout periods and product choices at least every 3 years. at least every 3 years. We should be going back through that. The review should be fairly quick and painless if we do it regularly.
Yeah, absolutely. Did you have any tips or tricks for the listeners out there?
Tips or tricks? Well, the big one is don't put your insurance policies in your safety deposit box. That's for sure. And you've hit on another big piece of it too. Make sure everybody knows where they can go to find the documentation or the person that will get them the documentation. One of the things that I see great advisors doing is making strong efforts to meet other pieces of the family, especially when they're dealing with mature children who have families. So we meet the grandparents, or we meet the kids, or we meet the other generation, so that they know where to go, they know who to reach out to. That's very helpful, because oftentimes that after somebody passes away, it's not a time of clarity for us, and so we need it to be easy. And oftentimes the advisor is really called to task at that point in their career to step in and help families at that point in time. So that's a big one. Revisit your plans. It's not a one and done. It's not a one size fits all. If it feels easy, ask why. And on that, I'm thinking sort of very specifically about two things. Number one, mortgage insurance. If the lender is saying check here and you're insured, and why would you want to meet with an advisor and pee in a cup and see a nurse and do all that? That just sounds like a lot of work. Well, maybe there's a reason why we do all that work. And I would argue that there is a really good reason why we do all that work. There's a really good reason why we want to be going through that investigation process with the insurance company up front, because it provides a very different contract for us during our lives. So if it seems too easy, maybe you want to ask why. There should be a certain amount of work done to put a multi-$100,000 or multi-million-dollar protection on our lives. I would also highlight too that we need to talk about insuring children more. We don't do a very good job of it, certainly in the North American landscape. There are other cultures that are actually amazing at it. And this is not a morbid topic. This is not a conversation about profiting on the death of children. This is about what we can do for our children because we buy the policies when they are so young and so perfectly healthy. There are phenomenal options, and that's why my two girls have 7 policies between the two of them, because they aren't getting younger or healthier. So I'm going to lock in that good health. I'm going to give them, as you said, money back options on their policies. I'm going to do something else that we didn't even touch on, which is I'm going to build in the ability to pay premiums only for a few years. And after those few years are over, nobody, not me and not them, will owe $1 more on this policy, and that's guaranteed for life. And so we can do this when they're young because they're cheap when they're young. They don't go through underwriting. They don't meet a nurse. They don't pee in a cup. They don't see a doctor. They're 15 days old. We can get them coverage, and nobody asks any questions other than, were they healthy yesterday? And you say yes. And there's huge advantages to that. The other advantage to permanent insurance, which again, we didn't even touch on because it's a 2-hour class in and of itself, is permanent insurance is the greatest tax shelter available to Canadians. It really is, but you have to understand how it works. Once you understand how it works and you look at using permanent insurance for children, and oftentimes this is that par or participating whole life type product, we can now start building substantial wealth for our children when they are terribly young, and we maintain ownership and control of that asset for as long as we want, and then we hand it over to them when we feel we need to, and we have set them up significantly for life.
I know I've had a few clients that have bought properties, like their first condo, or paid for their schooling with it. Mm-hmm. All of those types of things that enabled them to have that little extra by the time they reach their 20s and 30s.
Yep, without question. You can provide for houses and cars and weddings and whatever you wanted to use it for. But again, we're back to my statement earlier that money's a mechanism of choice, and if I can put in cents to create dollars, and I can do it for my children, just back the truck up. Really, just back the truck up and give me as much of it as I can. And that's literally what we're talking about. Cents on the dollar to create, guaranteed locked-in health, guaranteed locked-in insurance costs, and tremendous cash values, 6-figure, 7-figure cash values.
Absolutely. Yeah, and a lot of people aren't really seeing those pictures. I think they're just going down the trained temporary insurance route, and they really need to focus on what else is out there. And hopefully that's what listeners are getting from this, that there are
Well,
so many other options.
yeah, and that's what I would hope that your listeners are getting from conversations like this, is that there's a really big landscape out there for insurance. I can only speak strongly on the Canadian marketplace because that's where my experience is. But I can tell you in the Canadian marketplace that the banks don't give insurance advice, and the reason for that is because they can't. There is an act written by government that prevents them from marketing into the insurance space. And so many clients think that, I've got the creditor insurance, it's from the bank, I must be okay. You're wrong on about 4 different assumptions there. And so it's about taking that, that couple of hours out of your life to meet with a professional, to go over it, to make sure you know what you've got and why you got it and what you're paying for it. And as we talked about with the concept of temporary insurance, you know what you're going to pay for it later too. Because if it doesn't cost much now, I guarantee you it's going to cost a lot later.
Absolutely. Especially males for some reason.
Yeah. So when you spend enough time in the life insurance business, you learn some really interesting statistics. And I will tell you that I have learned in my time that we know that women last or live longer than men on average. I have also learned that women live longer when they are single. Men live longer when they are coupled. So that presents a real problem because that has us going against each other in terms of what we're trying to create. But the reality now, though, is that if of a couple, the statistical probability of one of the two surviving well into their 90s is very high. And we start looking at our children. Life expectancy for children today is going to be beyond that. And so when we get to talking about making a plan, we need to be making a plan far longer than we ever thought we had to.
It's because of all those good prescription drugs that we can get our hands on now.
Maybe we can chalk it up to healthy lifestyle but yeah, it's probably that too.
Or better love. I'm not sure what it is.
Modern medicine is wonderful. I think a big part of it is modern medicine is curing a lot of things that we couldn't cure before. You look at specifically something like cancer. Cancer would take people, where now treatment provides huge statistics about survivability. The reason why products like critical illness exist is because you're going to be here, and we need to protect your ability to maintain your life and livelihood and lifestyle when that's over.
When you need it the most.
Yeah, absolutely. And any advisor who's delivered a CI claim to a survivor, a fighter who's going through something, that's one of those days when we are crystal clear why we do what we do for a living, because we see the difference that it makes.
And, that's where I quickly learned when I became a life insurance person, advisor. I realized after you gave your first check to someone,
Yeah.
wow, that was life-changing for me.
Yep. I've told every advisor I've ever met who's come into this business that they will not understand what they're doing until that day. And they can't understand what I mean until that day, because no one can describe that. You just can't.
No.
The difference that you make.
The feeling, like my first delivery of a check to a family was on a group benefit package that I had put together for this company that she worked for in the office. And the husband, she just got on the plan, and 6 months later, her husband passed away. And I actually delivered a $5,000 policy to her. I felt so bad, but at the same time, I felt so good because she wouldn't have had anything if she didn't have some sort of plan of some sort. Because she obviously had looked at anything that she had, and she had nothing. She hadn't put anything in the works. Nothing had ever looked at anything differently. Didn't write any other policy ever before. So I soon decided that, hey, I did hit somebody hard by giving them $5,000, which is going to help them in the long run.
Yep. I mean, I think the truth is, if you're spending more time on an annual basis planning your vacations than managing your finances, then you need to take a good look at how you're spending your time, because we're not asking for much. I mean, in terms of reevaluating and keeping up to date with your plan, we're not asking for much. We need a couple of hours a year. That's all that's required. You know,
Hey,
a good advisor is going to do most of the work for you. You've just got to provide them the materials.
and Jared, we could actually go on a holiday, sit under an umbrella in the sunshine, by a pool, and talk to our financial advisor over Zoom.
Well, I don't think we can do that right now, but theoretically, when the world returns to its normal axis, yes, we absolutely. Yeah, absolutely.
And then you could tie both of those things together, your trip and your financial planning.
Oh, you may be onto something. You could start selling insurance under a palm tree. That would be an excellent marketing plan.
I think that's where everybody's just dying to get out of the house and get on to traveling somewhere.
Yeah, get some sunshine and a sandy beach. I would give an eye tooth for it for sure.
But when we do come across COVID this year, it has opened up my eyes to say to people, if you haven't planned yet, please do, because every day that goes by means that you might get COVID, and you might not be the lucky one that hardly sees any type of flu type symptoms. You might be one of those people in ICU, and you're never going to be the same ever again.
Yeah, and I would argue that it doesn't even have to be COVID. I think COVID has done a really interesting service to our industry in terms of helping people think about their health. I mean, one of the sort of 101 insurance advisor trainings suggests that there are only a few points in a person's life when they will naturally consider the concept of insurance. And that's when they have a baby, and when they buy a house, and when they get married, and there's only about 4 or 5 different places. This has provided a full stop for people to reconsider how they've been setting themselves up, because it's had effects on virtually everybody in one way or another. And some have profited greatly. And I don't mean that in a negative way. I mean that in a very positive way. Some businesses have absolutely thrived in this. I have some clients and friends who are in the technology business, and it's booming for them right now as people are embracing technology. But there's this moment in time where people are reconsidering what they've done and how they've done it and why they're doing it.
Yeah.
Take advantage of that, find a professional, get some good advice. And there's nothing wrong with getting advice from more than one person too. I mean, this is your moment. If you're going to take advantage of it, take advantage of it. Make sure you know who's bringing the advice to you. Talk to your friends and family around you. They're probably dealing with somebody fabulous. There's somebody there. We're easy enough to find.
And don't be like when you're buying a timeshare, or try to do that like when you're going in for a timeshare, and you say to each other as partners, okay, don't sign anything no matter what. And the other partner says, okay, we're going to make a pact. We're not going to sign anything. We're not going to leave here signing anything. So make that pact. So you go in, and obviously one of the two people do sign a document.
Yeah.
But look at your options. And if you don't like the first person, go to the second person and just give it some time and really understand what you're getting. Because I know if I sell a policy to someone, I have absolutely no fears, because I always make sure they understand it from the time they come in to the time they left and the next visit. If someone's pressuring you to do something, walk away and look at it again and reevaluate it.
The process that we put clients through should be a little overwhelming, because we should be bringing a whole lot of information that clients didn't have before. I don't think I've been in a client meeting process that hasn't stopped so that I could tell them that at any point after this point, you can tell me it's time to go home so you can think about this. Because I know I've given you a ton of information that you need a minute to assimilate. And that's fine. You're right. There should be no pressure. The right advice is the right advice. It's the right advice today, and it will still be the right advice tomorrow. And a good advisor knows that. A good advisor knows that what they presented.
And understanding it, what they've given.
Yeah, and that's the key. Usually with clients who become dissatisfied with advisors, whether it's wealth or on the insurance side, it's either because they never came back to provide service, or because they never understood what they bought in the first place. They bought it out of some form of pressure or obligation or any combination of things. I actually have a client that I worked with many years ago who owned, I think it was 13 insurance policies or 14 insurance policies. And it was just a husband and wife. And what they had done when I dug into it was they had basically bought a little policy from every insurance person who'd ever come to see them.
Oh,
And so they had these absolutely perfectly paired policies. It's like the his and hers version. Every time an advisor had come to see them, they bought another little policy. And they had no idea what they were buying, and they had no idea what it was doing for them. And at the end of the day, they'd lost track of all of them. And that's not a plan. That's not. I mean, it's better than not buying. I love that, but it's not a plan. Your advisor should be able to build you a big picture, show you where you are today, talk about where you want to be down the road, and then build the roadmap that gets you there.
right. Just like life.
Yeah, like Google. Google will get you there if you just tell them where you are and where you need to be.
Yeah. Yeah, that's for sure. Well, thank you so much, Jared, for taking the time out for our listeners this week on our wonderful topic of life insurance and disability insurances. It's we could talk about it, I'm sure, for 2 days, or at a convention, it's hours and hours and hours. But I'm sure we've given everyone some really good ideas and thoughts. And hopefully we've inspired and motivated some of you to look at your own situation and your own plan, because you do need your own unique plan for yourself. Take a moment and share this video with those that you love and care about, because it will make a huge impact on them and to you. Oh, and one last point, which I will put in our blog for life insurance, is that when we're sharing this video with others or this podcast, do remember that if someone else needs to take your children, like if you've done your will and you want to have a guardian for your children, they should also have a life insurance policy, so that there's some money there for them to look after that new job that you've just handed to them. So it does affect not just yourself, but look at your other, have your family meetings sometimes, look at what maybe you've given the something an executor a certain position, or you can tell your family you've bought life insurance and this is where it is. But do those kinds of things, because it's not just about you, it's about your family. Take a moment and share the video with those that you love, and it will make a huge impact on you and them. Our website is yourbackuplan.ca. Our weekly podcasts are on 8 different platforms. And we find us on Instagram, Facebook, YouTube, and LinkedIn, because family matters. Thanks again, Jared, for coming out. I will put your information, the description information, down below for our listeners, and our podcast, as well as our YouTube video that we have on the Thursday following. So thanks again.
Thanks for the invitation. I enjoyed it.
Yeah, it's always fun to talk about life insurance.